Chapter 2 practice exam. And at the end of class, the Chapter 2 exam will be mailed out. It'll be due on next Friday, which is that might be too long. I'm gonna make it due this Friday. I know it's early. I'll tell you what, I'll make it due on the 22nd. How about? That'll give you a good week. Okay, so this will be so at the end of class, I'll give you that. It'll be very similar to what's on the practice exam. Next class, we will start in Chapter 4. And I got an announcement to make about the class. Chapter 4 is actually, it's a little bit tedious, but it's actually pretty easy. I think I told you at the beginning of this session, the summer session, that I was going to skip Chapter 3 and then come back to it later on. And I've changed my mind. Actually, I haven't just changed my mind. It actually is in the adjusting entries, which are in Chapter 3, are in the class for entrance into the master's program. So I want to cover Chapter 3 because that you may very well be needing that for the entering. So after Chapter 4, which is easy, cover Chapter 3. Chapter 3 is difficult, but I think again, it's on the entrance exam into the MBA program, and at other schools, I'm sure their MBA programs have similar requirements. So it'll be a good thing to cover it. So we will cover Chapter 3. I said we'd wait until the end of the session, but I think we'll do it right after Chapter 4, just to make sure we get it in. And because it's a little bit more difficult, it might take a little bit longer. So I don't want to leave it to the end and then run out of time, basically. Okay, question on that? Okay, everyone should have the Chapter 2 practice exam. I emailed it. It's also in Blackboard. Is there anyone that did not get it? Okay, save this and get out of it. Okay, so I think we'll just go through this together. And some of these are a little bit repetitive, but that's part of it. The actual exam, I think, has 5 questions on it, 5 or 6 multiple choice questions, and then maybe like 10 problems on it. So it's not near as big, I guess, as this. So we're doing a little bit extra just to get a little more experience doing it. Okay, so let's go ahead and go through these. Oh, I also sent out this thing. Separately. It's also at the end of this handout, but I sent it out separately also. So if you want to pull it up next to it, you can. Okay, I'll say one more thing, and then we'll jump in. I know I've been saying that for a little while here, but again, the practice exam is very similar to the regular exam. Some of these problems will be the same. They may have the numbers might be a little bit different, but many of the multiple choice questions are exactly the same. That's not unusual in accounting that to have that, and that's because even on the CPA exam, they will. If there's a good question, they reuse it. So anyway, okay. So I tell you what, I'll read off the questions, and then you can, when you think you have the answer, you can yell it out, and we'll put up the whatever you guys yell out, and we'll put up the right ones too. So if it isn't right, don't worry about it. You'll get the correct one. Okay, collection of a $600 accounts receivable. Which is it, A, B, C, or D?
A.
Yep. Yeah, it increases the asset, cash. And decreases in asset, accounts receivable. I'm going to abbreviate accounts receivable. And you can too on the test. There's nothing wrong with that. So A it is. So your cash goes up, but your accounts receivable goes down. They no longer owe you. Okay. If an individual asset increased, then by the way, I'm giving extra credit points out on these. Oops, what am I doing here? For you guys that are here, you get extra credit points on multiple choice. Okay, if an individual asset is increased, then
C.
Which one?
C.
C is correct. Yes. And by the way, going through here, you'll find a lot of these are they go by this, the balance sheet equation. So it's called the accounting equation. Ah. Yeah, and so you can kind of, you don't have to put numbers in, but you can. Oops, what am I doing here? So if this increases, well, it's not going to balance. You have to have liabilities go up or equity go up or assets go down. So that's what this is. So if this is going to keep balancing, something else has to be done. And so this would be, okay, if you increase this, you have to also decrease the assets. Because decreasing these two would not make it balance. Okay. Purchase an asset on account.
B.
Which one?
B. Your asset increases and then your liability increases.
Yep. Payment of a liability.
D.
Yep. Yeah, your assets go down, your cash goes down, but also your liabilities don't owe as much. You paid off some of them. This one's a little bit tricky. Paid a dividend.
Yeah, this one is tricky, huh? D?
Close.
A?
Yep.
I knew it was either one of those, 50-50.
Yeah, and actually that kind of comes down to this. To, you know, so paying cash will decrease an asset. Okay, well, if it's going to equal, if the assets go down, then this side has to go down, one of these two. So, if this is going down, you're paying out cash, and we're talking about stockholders' equity, so this must also go down, so both decrease. It's kind of like okay. Courtney and company purchased equipment for $1,800 cash. As a result of this event,
C.
Yep, cash as an asset went down. Equipment, which is an asset, went up. So you're just trading one asset for another. So total assets will be unchanged. Debit to an asset account. Oops. Indicates what?
That's D, an increase in the asset.
Yep. Debits.
C.
Yep. Okay. They increase assets and they decrease liabilities. Nine, we didn't talk about, I don't think. Normal balance of any account. Okay, normal balance, what they're talking about for that is at the end of the year, is this account going to have a debit or a credit? Okay, and so it's kind of like on this one. So I'm going to. Okay, so if we're looking for, say, normal balance. The normal balance will be whichever side increases the account. I'll tell you why in a second. So normal balance, do something to make that a little different, I guess. Let's take the easiest one, assets. So at the end of the period, if there's anything in an account, will it be a debit or credit? Well, if you think about assets, for instance, let's say equipment. Now, if you had equipment, it would be a debit. You couldn't have negative equipment. You know, especially at zero equipment, maybe you don't have any equipment, but you can't have negative equipment. So these negative amounts, you know, the negative amounts are not going to be the ending balances. You know? So if there are any assets, if there's cash, you know, you can have zero cash, but you can't have negative cash. So wherever the pluses are, wherever the increases are, that's normal balance. Say, you know, for revenues, you could have zero revenues if you didn't sell anything, but you can't have negative revenues. Same thing liability and same thing with equity. So the normal balances are wherever the pluses are, wherever the increase is, those are the normal balances. All right, so coming back to this one. Oops. What the account is?
See,
See the side that increases. Account. So whatever side increases the account is going to be the normal balance. Expenses and assets, there'll be debits, revenues, liabilities, and equity, it'll be credits. Okay. Recording an account, an accounting transaction, the double entry system.
see,
Yes. And this one is a tricky one. It's a tricky one because of A. A kind of looks like, well, that looks reasonable. They, you know, debits must equal. They said the number of debit accounts must equal. Now you don't have to have the same number of accounts as long as the total amounts are equal. So the key word here is the amount of the debits have to equal the number of accounts. You may have 3 credits and 1 debit. That's fine, as long as the total for the debits equals the credit. So it's a little bit tricky on this one. And this one, there must be only 2. If this said at least 2, you'd be right. But it says only 2, you can have 2, 3, 4, whatever. This one we talked a little bit about. No, actually we talked about this one a lot. What am I talking about? When a company has performed a service but not yet received payment. So we did our work, but we have not been paid.
that's C. Oh, well,
So we did the work. Let me get rid of all this stuff.
okay, so you're saying like we're the company that did the work. in that
Yes.
qu-
Exactly.
Oh, so B.
It's going to be A.
Oh, okay.
So accounts receivable is someone that owes us, that's going to go up. So that'll be the, oops, down here. The debit will be the accounts receivable. And the credit will be the revenues. And revenues are expenses are the hardest ones to identify because sometimes it's not clear exactly what happened. You know, if you buy a piece of equipment, you know what happened. The cash went out, the equipment came in, but it's a little bit more difficult to. Yeah, so accounts with debit. So credit revenue, and this is something to remember about revenues. Revenues are always credits. So anytime if you see this, you know that that can't be right. We, unless there's an error, we do not debit revenue. Okay. When a company receives a utility bill but will not pay it right away.
B.
Yep. Yeah, so utility bill is going to be an expense. Nice thing about expenses, I get rid of all this stuff. Expenses are always debits unless something crazy happens. So expenses are always debits. So we know we're looking at these first two. And accounts receivable is when someone owes us. So I'm assuming that the utility company isn't going to pay us. We have to pay them. It's going to be an accounts payable. Yep, it's B. $13, and this is the one that's the wacky one that so wacky I highlighted incorrectly. That's how wacky it is. Company receives money in advance. We talked a little bit about this at the end of class last time.
This one's C, right? The unearned service revenue.
Yep. Yeah, this is a liability. This is, so they pay us cash ahead of time. And however it comes about, one of the things about accounting is here's the transaction, and you didn't make the transaction, so you just have to account for it. But it could be that maybe they got a discount for paying ahead of time. It could be that have bad credit, so they pay whatever it is. Now, this unearned revenue is not a revenue at all. This is a liability. Yeah, it's a little bit confusing, but unearned revenue is actually a liability. It's a liability because until we earn it, we're on the hook for it. So if they paid us $1,000 to do something, and we'd have to pay them back. Until we actually do the work, we have to give them their money back. So it's a liability. Now, hopefully, you do the work and then you count it as a revenue. Excuse me. But until then. Okay. This one really beats up the this thing here. If these are just one account. If cash goes up, revenue goes up, expenses go up or down, whatever it is. So for these, you're just saying whether it'll be a debit or credit. Don't worry about the other side. So cash increased by 560. Well, how they why? Don't worry about why. Just think about cash. The cash account. So don't think about what is what's on the other side of this. Take it for what it is. Okay, so cash is what kind of an account?
Asset.
Increases with?
Debit.
Debit. Oops. Revenue account increased by 320.
Credit.
Yep, revenues are always credits. Supplies account decreased.
Credit.
Yeah, supplies is an asset. It's going down. Accounts payable decreased. Accounts payable is a liability. Yep, it's going down. It will also be. I said also be a, sorry, I'll just be a debit. There wasn't the one before was a credit. Okay. Prepaid rent. Do we talk about prepaid? Prepaid is when you pay for something in advance. A lot of times rent, insurance, things like that get paid in advance. You paid ahead of time. You know, for instance, they have you pay your rent 3 months ahead of time or whatever. Or insurance, obviously, you have to pay it ahead of time. So these are things that are paid ahead of time, and these are assets. So prepaid rent is an asset.
Then it's a debit.
It increased by 1,200, so yep, debit. So it's an asset. Oops. Debit. Yeah, no, it's a bug just flew by here. All right, I'm in my basement, by the way. A few bugs down here. Is not. All right, bonds payable account increased by 700. Excuse me.
Credit.
Yep, bonds payable. All payables are liabilities. Increased. And by the way, you know, when you're taking this test, you know, there's nothing, it's open book, open notes. You can go back through here and look for something that it might not be exactly the same, but something that's similar to it. You know, figure out whether it's a debit or credit. Okay, utilities expense. Expenses are always
Debit.
Yep. Service revenue. Revenues are always
Credits.
credits. Equipment account decreased by 400.
So asset, so credit.
Yep. Yeah, asset going down, credit. And it could decrease by for a number of reasons. It could be sold it or something. Unearned revenue account increased by 580.
Credit.
Yes. Unearned revenue is a liability. If it increased, it's going up with credit. Advertising expense account increased by 750. Expenses are always
Debit.
Yeah. Okay. I think there's, I have a bunch on here, but I think there's maybe 5 or 6 of those on the test. I'll tell you something kind of odd, not odd, but it has to do, I think, with not seeing the whole picture. Is that you know, someone seeing the whole picture is a lot easier than someone simplifying it. But these in the past, historically, these are the ones that students miss more than the journal entries. These are missed more often than the journal entries, and I think it's because they start thinking about what the other side is. The revenue, okay, revenue. Oh, they must have got cash in or something. You know, just the revenue account. You know, whatever account is there, that's the only thing you're going to worry about. Don't worry about the journal entry. What's on the other side? You know, just whatever they give you. Revenue account increased with what? Debit or credit. Okay. And these are, you'll notice these are kind of similar to what we did before. So we'll go ahead and go through these. There's quite a few of these in here. I think I'm gonna go ahead and write in there in what they are. I wasn't doing this before. I didn't know if I used to do it all the time, but I didn't know if it would confuse people. But I think in this case, I think it'll be. I think you guys are familiar enough with it that it won't confuse it. Okay, so purchase supplies with cash. So we're using the supplies and cash account. Are the supplies going up or down?
You're debiting the supplies, they're going up.
Yeah, supplies. Is an asset going up. 200. Oops, that's a little more than 200. Okay. Now, again, as you guys are well aware, if you know what the debit is, you pretty much know what the credit is, and it's going to be cash. And it's an asset going down. Is it confusing when I put these in? Those?
No,
Okay. So you can look on this thing. That's confusing. Oops. Now it's even more confusing. Ah. Yeah, watch me learn how to use a computer. Fun, fun, fun. Okay, so yeah, so asset goes up with the debit, goes down with credit. So these are both assets. So this kind of tells you where their debits or credits. Okay. Borrowed cash from the bank using a okay, borrowed money from the bank using a note payable. So cash and note payable. Is the cash going up or down?
cash is an increasing asset.
Yep.
Debited.
And the tricky one is note payable, or notes payable is the account usually. Is it going up or down?
It's an increasing liability.
Excellent. Yep. So is the liability going up? Oops, oops, oops. Okay, received a utilities bill. Now, be careful on this. Does it say we paid it?
No,
No. It said we received it, so it doesn't say we paid it. So don't assume that it's being paid unless it says, you know, we paid it or whatever. So this is we just received it in the mail. Okay, so what accounts are we going to use?
is it an expense?
Yep. That's what makes sense. Probably utilities expense, but it could be other. You know.
So like expense and accounts payable.
Yep. So utilities expense and accounts payable. We owe these people dollars. All right. And the question is, what gets debited, what gets credited? Well, the nice thing is we got an expense there. And we know that expenses are always debits. So whenever you run into an expense, or a revenue too, but whenever you run into an expense, it's the debit. But revenues are also good because you know that they're credits. So now the accounts payable, is it going up or down?
It's going up.
Yep. So accounts payable, it's a liability and it's increasing. And it's increasing because we owe people more now. We owe them $150 more. Okay, so we owe $150 more, so this is increasing. Oh, employees for 1 week of wages. All right, well, first of all, does it say we paid them?
No,
Nope, not yet.
so it's the same as the one above. It's just wage.
Yep, exactly. Probably wages expense, something like that. Salaries expense also could be. But that's not how you spell expense. And expenses are nice because they are always debits. Oh, nice making joke. And accounts payable, you can put accounts payable. The book would probably have wages payable. Could also be accounts payable. Well, actually, if you want to abbreviate these two, accounts payable is AP, WP would be wages payable. But accounts payable would also be fine. Oops, didn't put it in yet. There we go. Oops, too much. Okay. Yeah, you'll notice that these sort of things, and quite honestly, the important words there are, expense and payable. Don't get too wrapped up in was it wages expense or salaries expense or whatever. If you have an expense and a payable for those two, I'm happy, because expense tells you me it goes on the income statement. It's going to be subtracted, and the payable says it's a liability. Same thing here, and that really is what you're trying to kind of categorize them into what they are. So, if you would say utilities bill, you put miscellaneous bill or whatever, or miscellaneous expense, I should say, or whatever. As long as you have the word expense, this is the important word. You should be fine. Use cash to purchase equipment. Cash going up or down?
Going down, it's getting credited.
Yep. Equipment must be going up. This is just trading one asset for another. And theoretically, what revenue make this, you're no better or worse off. Your assets are exactly the same. You probably bought the piece of equipment for some reason, but at least as far as we're concerned on the balance sheet, you just traded one asset for another. Okay. Pay cash for a truck.
Same thing as the one above.
Yep. Probably equipment. You can also put truck. Either one. And cash is way down. Yeah, so on this one, if you put equipment, that's fine. And usually companies will probably use the term equipment. They could also just put it what it is, truck. I've been in companies where they just use truck, the truck accounts. It kind of distinguished between stuff that we had out in the plant that would be equipment, and trucks were completely different driving around. So anyway, it could be either one of those. Supplies purchased on account. Supplies, are they going up or down?
Up.
So supplies, it's an asset. And so again, going back to this table here, if it's an asset and it's going up, it's going to be a debit. And the account, is it going to be accounts receivable or accounts payable?
Payable.
Good. Again, you can also just feel free to abbreviate that. Just AP is fine. Liability. It's going up. We owe $690 more. Oops. Again, just to kind of reiterate that, this is just a really quick hand way of writing down the transactions. It's someone's shorthand from 400 years ago. And it's quirky, but it works. And no one's found something better. It's another reason why we still have it is no one's come up with something better, which is kind of amazing. But how many things from 400 years ago do we still use? Most of them are like shoes or belts or something, but actual accounting, record keeping, and all that. Okay, perform services for cash. So we did some kind of service, and we got cash for it. Let's take the easy one. The cash, is it going up or down?
Going up.
Up. This is cash coming in. Now the hard one. Services.
Service revenue.
Yep.
Going up.
Yep. And for this one, whenever you see a revenue, you say yippee. Because it's a whenever revenue is going to be a credit. Revenue credit. So expenses and revenues are actually very helpful in that they're always the same because they're always increasing. Make sure I save this or something. Okay. Purchase office equipment on credit. Is the office equipment going up or down?
Going up.
Yeah, we bought it on credit, so what does that probably mean?
It's accounts payable. It's also increasing liability.
Yep, we now owe more. We owe $1,400. Just so you know, if you hear yelling in the background, that's not my house. That's the neighbors are having a barbecue or something. So if you hear a lot of whooping and hollering, that's not coming from me. We're just low-key accountants around here. Okay, purchased equipment and land. Okay, equipment going up or down?
It's going up.
Yes, 10,000. Land,
Same thing.
and by the way, you might be asking, well, why do we have to separate these? And I'll put it on here in a second. It's because we'll find out later on. Actually, chapter 3, the chapter that I told you we're going to be covering, that equipment doesn't last forever. You know, so equipment might last 5 years, 10 years, whatever it is. So the equipment doesn't last forever, so we depreciate it. We say, okay, we're going to write it down in the expense part of it. But the land, you never depreciate it. You know, this my house is here, but this house is going to get, you know, at some point it'll be torn down and another house put up. The land will still be here, so the land doesn't depreciate. So we always have to split those up. And I'm gonna put a note here in a second. Okay, we paid cash. You might imagine that went down. Okay, so on the test. Oops. Be sure to separate those two accounts. And the reason why we're saying, you know, don't put them into one account saying equipment and land. Why? Because they're going to be accounted for in the future differently. And so you want to have those separate. That land, $50,000 land is never going away. Whereas equipment will eventually get worn out, replaced or whatever. One of the ones more commonly missed. Received cash from a customer previously billed. Let's take the easy one. The cash is going up. Received cash, so cash is going up. Oops. So I'm going the other side.
AR.
Yep. So we already billed these people. So it's the AR. And this is an asset going down. You no longer owe us. Now, we're glad to get the cash. We'd rather have the cash than the accounts receivable. But as far as our assets are concerned, we got this asset, the cash went up, this asset went down because they no longer owe us. Sold stock to an investor. Or so common stock. Okay, when we say sold, what they probably give us?
Cash.
Cash. It's possible they gave land or something that they would have said that there should be anyways. So our cash is going up. Common stock going up or down?
Going up. It's an equity.
Yep, we now have more owners. So, these are owners. We sold stocks, and then we have more people that own the company, or the business, whatever it is. Might be a company, it's got stock. Right the first time. All right, yeah, so our assets are going up, cash, and common stock is also going up. And if you think about that asset equal liability, equal equity thing, you know, if this side, if the asset side goes up, the equity side, you know, if you're wondering whether it goes up or down, it's going to go up because the two sides have to be equal. Receive cash in advance from a customer. Well, I'll take easy one, cash. And the other one is a wacky one.
The unearned service revenue.
Yep. And this is the liability, and it's going up because if we don't do our part of the job, okay. Oh, I'm missing an eye. If we don't do our part, then we got to give the money back. So our assets are going up to give us the cash, but we also have a liability going up. And again, if we don't do the work, you got to give them the money back. Issued common stock for cash. Issued is the same as sold.
Sold.
Yeah, so issued is the same as sold. So I should. So when we see issued, think of sold. Same as the same as this one, actually. Okay, billed customer for services delivered. What's that one gonna do?
Accounts receivable and service revenue.
Yeah, probably gonna service revenue. Question on that? I think that's it. Yep. One second.